What is a mutual fund? Hi, I'm Brad Rue, owner of Action Financial Strategies, and today I'm going to briefly walk you through some basic investment information that seems to be lost on a lot of people. And it's okay if you're one of those people. Hopefully today you'll get a little bit of information that will help you make good decisions when it comes to investing in perhaps some of the different things you're invested in, whether it be your company-sponsored retirement plan, personal investing into mutual funds and other investments on your own, and get a little bit of information that maybe never was really shared with you before. So we set up a lot of different folks into retirement plans and things like that for their future investing goals. And one of the things that's often lost is, what is a mutual fund? Well, to put it very simply, if we could invest in the entire marketplace, which is representative here by this giant circle, right, and all these little dots. Let's assume that all these little dots are individual stocks, individual bonds, cash instruments, you name it, right? This circle will represent the entire market of things you can invest in. Now, years ago, it was very expensive, and it still can be today, for you to really get diversification amongst a whole bunch of different underlying stocks or bonds or other instruments, because you had to purchase a lot of these things to get that diversification. And when people didn't have a lot of money, and still people today don't have a lot of money to really get diversification by buying those individual things on their own. So what was invented was the mutual fund, right? A mutual pooling of funds that then went out and invested in all those underlying instruments, thereby passing along a certain percentage share of that fund to you. As you put more money in, you get more shares of that fund. And so we have funds out there in the marketplace, like a large company fund, right? Large company, large stock. We typically call it a large cap fund. Those could be growth or value and so on. You might have I know this is big stuff here, a small company fund. Also, representative of the size of the companies. There's small companies, there's large companies, there's mid-sized companies, go figure. And you have things like international companies, again, shocker, right? And maybe, let's just say, a bond fund, which are debt instruments issued out to the third party or second party investor by companies or municipalities or what have you. So let's just say there's these types of mutual funds out there that are pooling together other investors' money to go out and specifically, according to that fund's charter, basically what they set themselves up to be. In this case, maybe there's a large company growth fund, right? Large cap growth fund. You may have heard of the title in some of these different fund names. And that manager is going to go out and he's going to buy, according to the investment policy and things of that fund, he's going to go out to this giant marketplace of all the different stocks that he can get his hands on, and he's going to pick specifically large company funds, or large company stocks rather. And the same applies to the small company manager, the international manager, the bond fund, and so on down the line of all the different types of funds that are available. Now you might be wondering, okay, Brad, well, that's all good. I'm in mutual funds, perhaps in my 401k or other investments that I'm currently investing in. But how do I know what the right percentage of my money should go into each one of these funds? Now some folks will do a pretty, most intuitive way of doing things. They'll just go, oh, well, I got 4 funds to pick from, or maybe you got 10 or 5 or 6 or 11 or whatever number in your 401k plan, let's say. And I'm just going to put money into them all equally, right? Maybe you have 10 funds, you put 10% allocation into each one, equals 100%, right? Or in this case here, you might be 25, 25, 25, 25. Makes sense. Okay, I'm diversified, right? I got my large company, small, international, and so on. Now, unfortunately, simply putting 25, 25, 25, 25, and so on across the board isn't really a great way to get diversification. In fact, there's a few underlying things here that we need to mention that could actually be hindering your portfolio by doing that. And there is an efficient mix of all of these different, we call them asset classes, that will give you the most return or expected return for a given level of risk. For example, we wouldn't necessarily want to take on as much risk as, let's say, a small company fund, but only get returns of like cash or bond funds, which are typically a lot lower. Right? You'd be taking on a lot of risk or variance of return for not much expected return. So rather, we can come up with an efficient mix of all of these to get basically the most bang out of your buck, right? The most oomph in the engine. How do we do that? Well, it's a little more complicated than just simply putting equal amounts into each of these. And we follow a model called the efficient frontier. I'll simply draw it out here real quick so you kind of have an idea. But on this axis, we have risk going out this way. And on this axis, we have expected return going up that way. And all of our known portfolios and assets underneath here, even these mutual funds, right, are bound underneath this curve, right? All of these different portfolios and certain securities and so on are underneath that curve. So my point is, I could create a portfolio here, right, by some combination of, let's say, all four of these or more and so on, that has a known risk or variance of return number, right? That's when you see the standard deviation is typically a measure of risk in the data charts and things you look at. Maybe you don't look at them in your 401k. But we have a known level of risk and an expected return for that portfolio. Maybe it's a long-term average of 5 or 6 or 10 or 11%. Okay? Well, if I could take the same level of risk but be efficient, right? As efficient as I possibly could on that, what we call the efficient frontier, this frontier line of some combination of everything I could invest in to get me the most return for my money, or the level, in this case, the level of risk I'm willing to take. So same level of risk as you can see by these two portfolios, however, a higher expected level of return with the second one I drew. Well, gee, Brad, that sounds pretty complicated. How do I go about putting the right percentages in these? Well, thankfully, again, these answers of innovation, if I draw our same big securities world market here, and I have all of these different funds that I could put money into, the question is, how do I get efficiency? Well, we have created, I haven't, but the market, asset allocation funds, also known as target date or retirement date funds. Often also found inside your 401k plan. These specifically target a specific risk with an asset allocation fund. It might be growth, moderate, conservative, along that whole spectrum, right? Or defensive, conservative. Or they might target a specific date of retirement. You might be in the ABC retirement date fund 2040, meaning at around 2040, the year, I should be retiring, right? Turning 65 or somewhere close to that is typically where people target. And in that case, the fund starts off, the further I am from that date, the fund will start more aggressive. It'll start off higher up on this curve, right? More risk out here, higher expected returns. And over time, it'll slowly creep or glide down the risk spectrum as you retire or get closer to retirement. So what these folks are doing, the managers up here on these funds, they are going out and picking other funds or ETFs or some baskets of things that fill in all those asset classes, the large companies, the small companies, the international companies, the bond funds, cash, etc., that give me a more efficient mix to target either a risk level or a certain retirement date, thereby taking the guesswork out of, Brad, how much should I put in large companies and small and international and cash and bonds and so forth to reach my retirement goals? So there you have it, a little history lesson, a little understanding of the inner workings of what's in my 401k or my retirement plans, or perhaps even just available within my Roths or other things that I might be saving into for the future. And the differences between what's all out there in terms of a total market, individual mutual funds that have a specific charter, a specific goal, like large companies or small companies for their investments, and what these broader categories of funds like asset allocation and target date funds do and work on how they work inside your portfolio. Well, that's all for today. If you'd like more information, please contact our office or visit our website at actionfinancials.com. Thanks and have a great day.